From New York, for our viewers worldwide, Bloomberg Real Yield starts right now. We begin with the big issue, investors looking past near-term risks.
The economy is slowing.
Economic data are weakening quite significantly.
The economic data as of late, I think, is anchoring yields.
Some softening, isn't that surprising.
We can't even get this fiscal relief package done.
We do need a bridge for the next 2 or 3 months.
Look, I know it's really hard to look past the near-term data, but I think you have to.
It's a year of high noise to signal ratio.
You have to look through kind of the near-term weakness.
We need to start cutting through the noise.
The economy is very likely to recover in 2021.
We do expect things to get better as the vaccine rolls out.
We're going to return to pre-COVID levels of productivity and output in the second half of 2021.
Global investors are looking past the pandemic.
Joining us now is Collin Martin of Charles Schwab. Collin, question marks around fiscal aid, weakness in the data is revealing itself. Is the market right to be looking past that near-term noise and living in the back half of 2021?
We think it is right. Hearing all those clips from everyone else, we're in the same boat where we do think it can be a rocky next couple of months with cases rising as we enter the winter months. But there is light at the end of the tunnel. It's really fantastic news about the vaccine, assuming that the rollout continues as planned. And even with these minor hiccups with fiscal stimulus, we think something will happen. There's some uncertainty there right now, whether it gets passed next week, in a few weeks, whether it looks a little bit different. We don't know right now, but we do think something will get done. And that's going to be very important because we have seen some weakness recently. We saw some relatively weak income numbers, personal spending, retail sales, confidence appears to be dipping a little bit. So it seems like we do need something on that fiscal front, hopefully soon, to bridge that gap before we can get to something that does resemble something more normal sometime next year.
And the assumption is that will make yields move higher. You have a 1.6% target on the 10-year for 2021. Talk me through how we get there when we haven't even been able to breach 1% since March.
Yeah, it's been a challenge recently. After once COVID came and the pandemic hit, we thought the 10-year Treasury yield could trade in that 50 basis point to 100 basis point range. And it's kind of still stuck in that range, but at the high end. To get above 1% and to get to that 1.6 high end that we're expecting next year, we need to continue to see, ongoing positive developments on the vaccine. I think a lot of it hinges there so that we can get back to something that resembles normal. A lot of it does relate to the Fed. The Fed is going to be easy, even though we haven't seen many changes from them at the last meeting. We don't expect anything significant anytime soon. But with rates anchored near zero, more work for them to potentially do in terms of how what types of treasuries they hold and maybe changing the makeup of their balance sheet. We think that's all good news, and then fiscal stimulus potentially kind of gets us over there. When we look at where yields are now, still below 1%, those are extraordinary levels. They're very low, and if we can get past these next few months, we don't think that we need to see these extraordinarily low levels anymore, and we can see them drift a little bit higher.
But if we do see more of an abrupt material move higher, either on the nominal yield or if this curve gets steeper, do you expect the Fed to tolerate that? At what point would they feel they need to step in?
That's the million-dollar question. They probably would step in if that were the case. When we looked at the most recent meeting, when the Fed basically did nothing, the statement really didn't have many changes, and they didn't change their QE program. We thought that was about right because there's really no reason for the Fed to act right now. The rise to 95 basis points or so on the 10-year has been orderly. The Treasury markets are functioning properly. If we were to see that change and we were to see a quick, sharp jump in Treasury yield, that's probably when the Fed would act and maybe change the makeup of their balance sheet, maybe focus more on longer-term treasuries. But as long as yields are rising, orderly and for the right reasons, which at this point we think they have, we don't see the need for the Fed to change much. But if we do see that abrupt, quick jump higher, that's probably when they'll act.
All right, Collin, I have to cross over to the other side of the Atlantic because, of course, we did get news finally of a trade agreement between the UK and EU for what post-Brexit is going to look like. In anticipation of that agreement, we saw gilt yields move higher to the tune of 10 basis points on Wednesday. Do you think that's the right call here? Do you think gilt yields will continue to move materially higher?
Probably not materially higher, because when you just look across the globe, there's so many factors that are keeping yields low. So yes, this is good news for the UK, for the UK economy, and that should pull yields up a little bit. But I don't think it would lead to a continual trend higher, just given the weight of global yields elsewhere, given easy financial policies just across the globe. The number of negative, the amount of negative yielding debt that's still out there, that's going to limit how much yields anywhere can rise, and that includes the UK.
So how does your calculus for the BOE now change, given that it isn't a hard no-deal Brexit scenario? Does that take negative rates completely off the table?
Well, it's certainly good news. We'll see if it means it's off the table. But any way you slice it, this is like a weight that's lifted off of everyone's shoulders. We've joked, and a colleague of mine makes this point a lot, that we'll always have Brexit. Maybe we won't have Brexit for much longer, and that takes one uncertainty out of the equation when the BOE's coming up with its policies. But we'll see how it evolves over time.
All right, UK, obviously one area of international markets. What about EM? I know you like EM debt going forward into 2021. Where specifically?
Well, we take a very broad-based approach when we provide guidance. So we just like emerging market bonds in general, and that can be U.S. dollar denominated or local currency denominated. We have a few key reasons why. The first is a weaker dollar. We don't expect the dollar to trend significantly lower, but we think it can weaken in 2021. And even at the levels we're at today, it's weakened a bit, and that's a good thing for emerging market economies. Makes it easier to pay back any dollar-denominated debt they may have. With the weaker dollar, we've seen a rise in commodity prices. That's good for emerging market economies. And then just a general recovery of the global growth picture, global growth scenario is good for emerging market economies. Now, we don't expect returns to really match what we've seen recently. After spreads surged in March and April, we've seen really strong performance, and now spreads and yields are relatively low, but we think we need to look at spreads and yields a little bit differently today, given the interest rate environment across the globe. So we think emerging market debt is attractive. We think they still can continue to earn excess returns, positive excess returns in 2021.
All right, Collin Martin of Charles Schwab, we have to leave it there, but thank you so much for joining, and happy holidays to you. Time now for the final spread. The week ahead and coming up on Monday, we get Dallas Fed manufacturing activity data, then a busy Wednesday with wholesale inventories, pending home sales, and Chicago PMI numbers. Plus, we get PMIs from China. The last round of jobless claims for the year comes in on Thursday, plus the UK formally leaving the European Union. And finally, global markets are closed on Friday for New Year's Day. That does it for us. We will see you next year. Happy New Year, everybody. This was Bloomberg Real Yield. This is Bloomberg TV.